Using the information in question 17.8 now regarding the intragroup sales of inventory, let's see if we can draw up the journal entries first of all for the sale of inventory and the profit that sits in closing inventory. Now if you look at the additional information in this question, they first of all told us that intragroup sales of inventory for the current year was from Summer Limited to Kiera an amount of $14,000, and in the other direction amount of $3,000. Okay. So this gives us a total of $17,000 worth of sales resulting from transactions between companies within the reporting group. Now, as we know that from a group perspective, intragroup sales does not occur and therefore needs to be eliminated in full. So the first leg of our journal entry will be to remove that sales from the sales line item in our income statement. So we're going to debit our sales account with the full amount of intergroup sales. Now we know from our entries that the credit should be cost of sales, and if there's any inventory on hand at the end of the financial year, also an adjustment to our inventory balance equal to the unrealized profit that still sits in inventory. Now in part B of the additional information, they gave us information on the closing balance of inventory. So they said at the end of the financial year, Summer Limited held inventory that included a profit of $200. So that is the unrealized profit sitting in closing inventory. So in this case, we just calculate cost of sales as the balancing figure. Because we adjust the carrying amount of an asset, we have to take into consideration deferred tax adjustment. So we create a deferred tax asset to the value of $60 and the credit going to our income tax expense account $60. So of course this is just to record the movement in the deferred tax asset. So that's fairly simple. We first of all eliminated the profit in the income statement lying in the subsidiaries accounts, or basically in both entities' accounts, because there were sales in both directions, eliminating the full sales transaction, the transfer to the cost of sales, and then also eliminating the unrealized profit that still sits in closing inventory. Now let's look at the treatment of a situation where the inventory was transferred in the previous financial year and sold in the current financial year. So at the end of the previous financial year, there were unrealized profits sitting in the closing balance of inventory, similar to what we've just done. Because that inventory is still on hand at the beginning of the year, we need to adjust the opening retained earnings in order to balance our accounts with the closing balances of the previous financial year. So what information was given regarding this situation? First of all, the question told us that inventory on hand at the beginning of the year included a profit of $400. So that is unrealized profit in the opening balance of inventory. That unrealized profit was realized during the year based on the assumption that any inventory on hand at the beginning of the year is sold during the course of the year, unless the question of course states something specifically to the contrary. Now, before taking this discussion any further, let's think of what the entry would have been at the end of the previous financial year. So if this is 30 June 2011, similar to what we've done in the previous example, the $400 unrealized profit would then have been in closing inventory. So the adjustment in the previous year's consolidation worksheet would have been to debit our sales, credit our cost of sales, credit our inventory, because of the inventory entry we have a deferred tax asset, and the movement goes to the income tax expense account. Now, I deliberately made these counts in different colors because I want you to see that the sales and the cost of sales and the income tax expense, those three accounts all appear in the income statement and therefore affects our retained earnings balance. So if we had to recreate this entry at the beginning of the year in order for our opening balances to agree with our closing balances of the previous financial year, so our opening balances on the 1st of July 2011, we would have said debit sales, credit cost of sales, credit inventory, debit deferred tax asset, credit income tax expense. But because it's in the following financial year, this would have been replaced, and that by retained earnings opening balance, retained earnings opening balance, and retained earnings opening balance. Further to that, because of the assumption that, let's just get another color here, that our inventory is realized during this year or sold to an external party during the year, we also would have had an entry to adjust this inventory or to transfer this inventory adjustment to cost of sales. So we would have said debit our inventory with that same amount and credit cost of sales to reflect the fact that the inventory has been sold, and the deferred tax, because the inventory is derecognized, is reversed in the current year. So debit income tax expense and credit our deferred tax asset. Okay, so now we can say that those two will cancel out and the deferred tax will cancel out. So we're left with, let's bring in our yellow, we're left with these accounts and those entries. If we consolidate into one entry, we'll have debit retained earnings opening balance. So this is now on the 30th of June 2012. So this is the entries that we'll include in the consolidation worksheet at the end of the year. Debit our income tax expense and credit our cost of sales. So that's the cost of sales, income tax expense, and these three all affect our retained earnings opening balance. So this is the entry that you can study for adjusting or any unrealized profit in the opening balance of inventory. What I try to show you here is just where it originates from until we've got this shortened version of the entry. Okay, so applying this to this question, where we know that the inventory on hand at the beginning of the year had a profit included of $400, it means that we credit our cost of sales with the $400, which were the unrealized profit at the beginning of the year, but of course it has realized during the year. Now the cost of sales for the group is $400 less than what is recorded in the parent account's records. The reduction in the cost of sales means then an increase in profit. So the group's profit is greater for this year than the sum of the legal entities together. And the unrealized profit in the previous year is because the unrealized profit in the previous year is only realized in the current year on a group level. We debit retained earnings opening balance, and that reduces our retained earnings opening balance because the group profit for last year are less than the sum of the retained earnings recorded by the legal entities. The reason being that the legal entities, so the subsidiary and the parent companies, recorded the profit on the sale of the inventory in last year. So when they recorded the sales and cost of sales last year, they already recorded this the profit on the sales transaction. But we reversed it on a group level, and we're only recognizing it now on a group level. Okay, and we debit our income tax expense with the reversal of the deferred tax asset. So that is 30% of the 400, so 120. The retained earnings opening balance adjustment is 280. The last scenario is just considering what the adjustment would have been if the inventory was transferred in the current year but also sold to an external party in the current year. So let's take the same example, number 3 of this question, question 17.8, and we use the information that we used to look at a profit in closing balance where the sales were 17,000. So in the group company we had intergroup sales of $14,000 and $3,000, so a total of $17,000, which of course from a group perspective has not happened. So we'll reverse the sales figure, sales revenue 17,000, and because all the inventory has been sold, everything has been transferred to cost of sales, so that is then 17,000, and there's no inventory on hand at the end of the year, so there's no inventory adjustment. Also because there's no adjustment to an asset, and it's only income statement accounts that are affected with the adjustment, there's no deferred tax adjustment required. Okay, so that is where inventory was transferred and sold in the current year. Okay, I hope with this video clip I've clarified some of the problems you struggled with elimination of an inventory transfer, intergroup inventory transfer. If you have any further questions, you're more than welcome to post your questions on my Guru, where I can be able to respond to you.